Just during this. Good morning, and thank you for joining us. I'm Eric Uhlfelder, founder of Global Investment Report, and I'm thrilled to be co-moderating this remarkable panel of EM experts from around the globe. They include some of the most consistently performing hedge fund managers to be found across the entire industry, along with a leading global allocator who helps direct emerging market and impact investments. What inspired this event were the findings from this year's 21st Annual Global Investment Report's Hedge Fund Survey of the world's most consistent managers. Based on the past 5 years through 2023, 6 of the 50 most consistently performing managers across well-established broad strategy funds were in fact emerging markets focused. And through the first half of 2024, the top performing strategy within these 50 funds was emerging markets. And 2 of the top 3 performing managers in the survey, Sandglass and Anco Africa Debt, are with us today. For those who aren't familiar with my annual report, I've been tracking hedge funds for more than 2 decades for the Financial Times, the Wall Street Journal, Barron's, Institutional Investor, and SALT. And since 2020, I've been producing this report under my own banner, Global Investment Report, with the sole purpose of identifying the handful of funds that deliver on the promise of active management. And precisely to that point, the average age of the funds on this survey this year is over 15 years. Helping me to moderate today's event are Anna Nizol, former head of product development and CMO at Rothschild & Company, and Linus Nielsen, founder of the alternative database, Nielsen Hedge, and a systematic trader. During this event, feel free to submit questions in the comments section. Now I'm pleased to introduce Gena Lazowski, CIO of Sandglass, Mahak Bhatia, a PM at Wellington Management, Manuela Chadamas, head of EM and Impact Strategies at Investcorp Tages, Craig Stanley, COO at Anco Africa Debt, and Carl Tomei, PM of Cheney Capital's EMEA Fund. And before we start with the questions, I just want to allow the panelists to say a few words about their work. Gena, would you like to lead off, please?
Sure, I'll just say a few words. Thank you very much, Eric, for your kind words. And thank you very much to the panel for taking the time to share their thoughts and insights on emerging markets investing. I'm CIO of Sandglass Capital. We are a global emerging markets special situations fund that focuses on broad EM investing across the capital structure, across emerging markets. We have offices in New York, London, and Dubai. Our efforts are typically focused on sovereign and corporate credit situations and occasionally tactical equity situations. We've been in business for almost 12 years. And we, are grateful that you've invited us to share our thoughts on the evolving EM landscape.
Terrific. Craig?
Yeah, thank you. Good afternoon from London. Anco is an Africa specialist investment firm. We've been around since 2008. The fund we'll be discussing today is the Anco Africa Debt Fund. It is a macro relative value hedge fund that sources its returns from the listed liquid Africa ex South Africa sovereign corporate hard and local currency space. We're about 45 people. We manage nearly $800 million. And we have offices in London, Johannesburg, Cote d'Ivoire, Cameroon, Rwanda, and Mauritius.
Thank you. Mahak?
Hello, everyone, and good afternoon from London. I'm Mahak Bhatia. I'm a portfolio manager at Wellington, focusing on emerging market sovereign debt and directional credit. I have 21 years experience in emerging markets. Prior to Wellington, I used to be a portfolio manager at Brevan Howard, and before that, I used to run the emerging markets trading business at UBS, and before that, I was at Morgan Stanley and Deutsche Bank. So look forward to speaking about emerging markets today.
Terrific. Carl?
Well, good evening from beautiful Dubai. I'm part of Cheney Capital, which is an investment manager based in the UK, managing mainly assets in private credit and real estate. but I am part of the equity sleeve where I manage a long-short EMEA, so it's kind of a niche part of emerging market, and the fund has been operating since 2008.
Thank you. And Manuela?
Hi, everybody, and good afternoon from continental Europe. I work for Investcorp Hedge. We are a global asset manager specialized in alternatives with offices in the US, in the UK, and in continental Europe. We have institutional client base, and we provide external multi-manager portfolios. We also have internal managed strategies, and we partner with several hedge funds, both for seeding and for our UCITS platform.
Thank you. Okay, we'll get started now. And as I mentioned in my introduction, I was really surprised at how well represented EM was among the most consistent managers, which includes the like of Citadel, D.E. Shaw, Millennium. And so it was a thrill to see funds that were exposed to such volatility as we've seen over the past couple of years, especially when rates rose, as well as the impact of COVID, doing so well for so long. And again, to remind our viewers, there's a minimum of 5 years through 2023 in which funds had to meet the hurdle rate to qualify. So that begs the question to each one I'll ask, except for Manuela, who's not a PM. How have you been able to deliver consistent returns and, most importantly, manage risks so well so that you don't suffer significant drawdowns, which are always so challenging to make up during any one particular year? Genna, you've had a remarkable start to 2024, as well as a very impressive trailing period. So let's see what your magic you can tell us about how you're doing.
Thanks so much, Eric. Although I would say we're already in October, so I do think the year is slowly coming to an end, unfortunately. But look, I think every investment manager has their own risk management framework. When I started in this industry, I was taught that you get in trouble when you commit one of three errors. When you're over concentrated, over levered, or run into liquidity constraints. So I think any risk framework that addresses the goals that you've described requires addressing these potential errors. And I think one helpful risk framework, certainly for thinking about emerging markets, is to focus on what I think are important areas for investment. Number one is to think about deep value. And I think when you focus on cheap assets with low downside risk, that minimizes the chance of potential losses. Even in the event of corrections, losses can be muted, and at the same time, they offer attractive convexity and, of course, the benefit of sharp gains. And so in that respect, you kind of create leverage, if you will, in the underlying assets rather than overlaying a whole layer of financial leverage, which can get you into trouble, if you will. I think secondly, heavy focus on idiosyncratic ideas is important, owning things that other people don't, which of course reduces market volatility and avoids being the victim of the herd running in the wrong direction. I think in any value framework, you have to obviously be, at least in my mind, I think an event-driven mentality is very important to avoid value traps. And so I think it's important to handicap turning points. And as you know, EM certainly have no shortage of events. I'd encourage, in fact, sometimes maybe too many events, but I think that those events can be a big source of opportunity. And then lastly, I would just say, I think active portfolio rotation, which relies on the liquidity that you've hopefully paid attention to in making your investments, and to turn those investments around is something very important. You should always need to stay focused on doing what you know how to do while leaving, when an investment fits into someone else's investment framework and life cycle and doesn't fit into yours, to move on. So I think such a framework, I think, has the chance of avoiding some of the key sources of volatility that you've said can get you into trouble. And I think the good news in EM is that there's just a tremendous supply, a plethora of assets across sovereign credit, corporate credit, single name equities, and even local currency, and I think hopefully, fortunately, we'll have people on this panel who can address all of those case studies. And just given the plethora of assets, political economies, cultures, et cetera, I think there's quite a quite a attractive source of potential ideas that fit into the framework that I described.
Thank you. Craig, I featured a profile of your fund a couple of years ago in my 2022 survey, I believed. And I have to admit, I was a bit nervous thinking that an Africa debt fund could be the source of consistent returns. And you've certainly proven that selection to have been somewhat prescient. And you managed through the interest rates rise of the past couple of years. And even though it was a bit volatile, you've done very, very well to always stay up to deliver profits. So next to you, then that question is, how do you maintain this consistent performance while managing all the risks that no doubt are in your space?
Well, I guess maybe in somewhat opposition to what Genna just said, I'd quote Andrew Carnegie, who said, to become rich, keep all your eggs in one basket and watch that basket very, very closely. So we are specialists in the Africa space. That is what we do. That's where we focus. Within Africa, you get a lot of tourist investors. It's a very binary trade for many investors. Risk on, risk off. So when they like it, they come in. When they don't like it, they leave, and that creates dislocations in the market. As a hedge fund, and having built the infrastructure to truly have a 360-degree view of the market, to be able to be truly long, short, both hard and local currency, to be able to have a vast infrastructure, because one of the problems in our space is very simply having access to markets and being able to be a provider of liquidity. We have two principles at ENCO. One is we don't take principal risk, which may sound odd operating in an environment like Africa, but in our mindset, if we are not 100% certain that we will be repaid, we do not make the investment. But the second principle, which has proven to be in my 16 plus years operating in the frontier space, has probably proven to be the truest of all maxims, is that if you are structurally the supplier of liquidity, then you have structural alpha. That as long as you can structure yourself to do that, and within the debt space, we have been able to focus on parts of the market where we can structure investments to hold to maturity, optimizing our liquidity through the act of maturation rather than being a price taker on the liquidity side. And obviously that liquidity is very dear when you want it most. So I would say, again, to echo what Jenna said, is that the risk framework is paramount. Having a very strong structural framework for understanding the underlying issues in Africa is paramount. This allows us, when dislocations do happen, to be able to move very quickly, but also to be able to tell when effectively the time is ripe to exit. So that's effectively what we've done. And also the point made earlier about being greedy. We can structure our portfolio for very high returns. We do not. Most of our assets, and 88% of our assets that we manage, are for pensions within our hedge fund. They are, if we're making 10 to 15%, they're ecstatic, right? So that is where we start from, and that's what we structure to build, which allows us to control the risk very strongly within the portfolio, given the notional returns available in Africa.
Thank you. Mahak?
Yeah, I'll echo both Greg and Jenna's points. I'll agree a little bit more with Jenna. I think 3 points for me are key. Like when I look at emerging markets, I think I look at what we can do best is differentiation, diversification, and then convexity. So by differentiation, I mean, when we're looking at the sovereigns, we're doing an in-depth research on all the sovereigns. We have 4 in-house economists who look at the whole world, look at what drives which country and where they're going. And then what we try to do is combine it with the macro environment and look for the winners and losers. And in every macro environment, I think there are good winners and losers depending on what is doing well at any given point in time. And I think in the last few years, it's become even more paramount what those winners and losers are, because as interest rates went high, capital was being pulled out of emerging markets. a lot of emerging market countries had to look for other areas where they could get sources of capital, which wasn't public markets. And I think they're identifying which countries had access to that capital, whether that is through multilaterals, whether that is through access to other sovereign wealth funds and so on. I think that's what really helped them survive over that period, and versus others which ended up in distress or in a default in certain cases because they did not have access to that capital. So I think differentiating that is key. And to Craig's point on that, knowing, because we do have a lot of pools of capital that have been coming into emerging markets over the last few years, whether that is through ETFs or through crossover accounts, who are much more coming in and out based on just on the macro framework rather than doing their in-depth research. So I think there are those opportunities that get created, and having done your research, knowing when to get into a country and knowing where that opportunity is, I think is key. And then the second point is obviously diversification, which Jenna mentioned very well. I think risk management is central to any framework, making sure that you're actually diversifying your portfolio across a broad set of bets, not putting your eggs in one basket. Sorry, Craig. But making sure that if you do get one trade wrong, that it's not going to be the end of the world. It is actually different sets of themes which you're playing across. And then to Jenna's point, convexity is very important. In emerging markets, you do get that very often. Like in the last few years, because of higher interest rates, we have seen a lot of countries where the sovereign external bonds are trading in the 50s or 60s cash price, which really is a very convex way of playing that and getting access to that without taking much financial leverage. And even if your view wasn't right on some of those countries, your downside is a lot more protected. And I would go a step further. It's not just about going into what is the most convex asset, but even before that, doing your security selection to see what is the best way to play one of those countries, like whether that is a quasi-sovereign in that country or a corporate in that country that might have the same kind of upside in case a sovereign does well, but have much more limited downside because it has access to other pools of capital or it is not that leveraged. That also makes a big difference to getting much higher returns and much better Sharpe for us compared to a lot of other funds.
Let me just ask, because you've been running the fund longer than any other fund we have on the panel, and you're the largest. Just very briefly, your risk management comes from all the processes that you pursue in search of investments, but are there any particular risk management tools that you overlay to help maintain stability in your returns?
We do have a proper full risk management system that looks at what will be your returns in case one particular country bet wasn't right, or whether if there was your macro bet didn't go right. So we do run a lot of scenarios. Like right now, we're doing that work based on US elections and whether it'll be one candidate or the other and what their policies would be and how our portfolios will perform in those scenarios. And we operate within internal rules and sets basically to make sure that we're not losing more than a certain amount of money in case we are tilting the portfolio one way or the other. And I think that allows for that diversification in different sets of bets to happen rather than just putting all your eggs in one basket to that point.
Thank you. Carl, I hope we haven't taken too much out of your answer with all these very good three previous answers, but go for it. Let us know how do you, I've known you for a while. I featured you in the Financial Times years ago because I was so impressed by your work. Tell us, if you can, how you manage your consistent performance and how you manage downside so effectively.
Listen, I mean, it's great because everyone has a different approach, and it looks like it's working for all of us because we've been in business for quite a long time, I think, which is difficult in this part of the world. I think active management looks like it's completely out of favor in developed markets, but in my view, it's definitely the way to go in emerging market. If you look at most emerging market managers were able to deliver in excess of their benchmark, especially if you risk adjust. Also, I mean, it's our case anyways, and I'll put it down. I mean, our approach is really to start with a macro top-down allocation to risk, and we think that there are a lot of variables, macro variables such as commodity prices, interest rates, the dollar, that affect appetite, global appetite for emerging markets in general. And then, I mean, honestly, you have to know what you're investing in. I've been investing in these markets for 24 years, so you need to know. You have to have local knowledge on the ground, know who to talk to, and put all this information together to see what is the risk reward available to you. And then I'll go Jenna's way. I don't put all my eggs in one basket, but I tend to definitely overweight high conviction, not too much diversification, some of it, but not too much. But liquidity for me is up there. I need to be able to say, sorry, I was wrong. My thesis doesn't work, and not have to suffer a massive drawdown to change my mind. So we only invest in liquid situations.
Terrific. Linus?
Thanks. I think this is a question primarily for Craig. We during sort of 2022, 2023, we saw a large amount of interest rate changes, primarily from the Fed. That together with sort of a number of local policy changes, saw some mass. I'm thinking about the Egyptian pound that saw basically a neck breaking declines. How would you actually manage that? What's the risk of ending up on the wrong side of one of those moves?
I mean, look, yeah, the Egyptian pound started off 2022 at 15.7. We're now at 50, and this probably gets to what I was talking about earlier in the framework. We were invested into Egypt beginning of 2022 in the local currency. Due to a variety of factors that had happened in other markets, specifically Nigeria and Ghana, and looking at how long the trade had been on in terms of when they devalued in November 2016, their FX went from 9 to 18, then settled back down to about 15, which is a normal devaluation, then resettling and finding its equilibrium. Effectively, the Central Bank of Egypt had been pegging the currency for several years at that point. A basis was starting to form, or there was pressure, and then we made the seminal decision to exit that trade at the end of January through the beginning of March. And I think 19 days after we finished our exit, they devalued the first time from 15. I think it was down to 21. And then it subsequently went from, I think, 21 to 24 to 30, then to 50. And I think this is where within our process, that we're a macro manager, so it comes at two levels. One is, what is the global context? So again, and by the way, we have 54 African eggs to deal with, so it's not just one basket of eggs. So there's a lot of eggs. It just happens to be in a basket called Africa. But the element was that Africa is never going to cause the problem. It's a tertiary market, but it's always going to be the recipient of the fallout. You can have coups, you can have election disturbances, you can have natural disasters, you can have civil wars, and the rest of the world yawns. And Ukraine gets invaded by Russia, and then everyone is telling me that Egypt is the world's largest importer of wheat, which was true. And that was an issue in February of 2022, and by June of 2022, the price of wheat was back to where it was, but no one was talking about it. So you have a sensationalism that comes into our market. So there's a need to have a broader context for the global pressure on Africa, again, as a risk-on, risk-off market. And then there's the country-specific situation. So the issue with specifically Egypt and its devaluations were that you went through four legs. And those four legs, if you got in prematurely, you would have been hurt very badly. And the issue is that in our space in Africa, one of the things that we know is that FX, it depreciates. right? Unless you're in one of the peg currencies, the West African, Central African franc, or the Moroccan dirham, which is obviously is effectively pegged to the euro, but it's a basket, but it's really the euro. You're going to have either some level of depreciation, either slow, moderate, or rapid. So the largest problems have been in the hard extractive countries like Ghana, Nigeria, and Zambia. But having that framework to understand that the devaluation may not be sufficient on its own, right? So in the case recently where we did reach the current level of around 48 to 50 on the currency, and again, this is a permanent impairment of your capital, and the problem, it's never coming back. So if 2.5 years ago you were in Egypt and you were at 15.7, it's never going back there. So you have taken a 70-ish% hit on the FX. And this is one of the reasons why a lot of investors get scared away by Africa, because if you look at the MSCI Emerging Market Frontier Equity Index ex South Africa, I believe that index started November 30th, 2008 at 1,000. I think it's currently 635, which means that you have lost roughly 35% of your money cumulatively without any fees or costs over 16 years. Right? So, from an allocator's perspective, as a backward-looking bias, this is going to be a problem. But having that framework to understand that the first deval, the second deval, the third deval were not sufficient. When we hit the fourth devaluation, you then had a confluence of events that fit within our framework. So when they did it on March 5th of 2024, we had no exposure on the morning of March 5th. And by the end of March 5th, we had a very large exposure, because you had policy, you had interest rates, and you had currency levels now basically come into an area that made it a very attractive trade. So that's how we deal with it, is understanding that you have to have multiple legs to make it attractive from a macro perspective. And that is how we avoided the FX hits that happened in 2022, 2023, because it was about, I think, a 20-22 month period where you had the largest drawdown in African local currency debt in the indices history.
Thank you. Manuela, I hope you don't feel left out, but here's a question as our sole allocator on the panel. Your process for identifying investment opportunities in EM and then determining which funds are in the best position to exploit those opportunities. And as a follow-up to that, how do you determine weighting in the broad portfolio at Investcorp Tages that EM should have in an overall balanced portfolio as Investcorp Tages defines it? So I hope I haven't put too much on your plate, but whatever you can answer, much appreciated.
Quite a lot. Well, let me tell you first that we have been investing in emerging and frontier markets for a very long time. So I believe that what was said before by the other panelists is absolutely important. And there were some keywords that I think were given during the previous discussion that are key also for our selection. We invest through managers in the emerging and frontier market space. So it's very important for us to find partners that we trust. And we like a lot emerging and frontier markets because they give an incredible amount of opportunities, because they are complex, because they are volatile, because there is a lot of dispersion. At the same time, there are a lot of risks. And I mean, you just listed them. The most important for us is obviously liquidity. Very, very important. So I would say that it depends also on the appetite of our underlying investors, how much of emerging and frontier markets we can actually include in our portfolios. But definitely we have to be comfortable with how the managers are managing the liquidity risk. And here it comes, our ability to do the due diligence, which is not just the investment due diligence, but I think it was mentioned before, it's very much about the operational infrastructure of our managers, because dealing in Africa, for example, is extremely difficult. And so you have to make sure that your fund has all, the necessary tools in place to proper deal in the various markets. The other point that for us it's extremely important, and I think it's not just by chance that these managers have been doing well for time, is that you have to invest with somebody that has experience. And this experience has to be through different economic cycles. They have to know very well not just the markets they trade, but also the countries, the legal and fiscal framework, which is extremely important to be successful. So for us, these are all elements that we take into account when we look at managers. Other 2 points that were mentioned before that I think are very important. We invest only in long-short managers, so active management is for us key. And another point is diversification. It has to be appropriate. I don't think there is a standard amount of diversification. It depends on the market, depends on the regions, depends on what kind of sectors you're looking at, but it has to be assessed on a case by case. It's very difficult to standardize in the emerging markets and especially in the frontier markets place because every region, every country is different from the others. They have their own drivers, and so it has to be properly assessed. So that's the way we do our job of allocating to managers in the space. And weighting emerging and frontier markets is again most of the times is conditional to the kind of guidelines that we have from our investors. Depending on those guidelines, we always like to have some exposure in this space because they bring, correlation to other strategies. And yeah, if there is more appetite, I mean, we're very happy to increase the allocation. At some point, we were running also a mandate which was fully dedicated to small emerging and frontier markets across strategies. So again, it's not probably the answer you wanted to hear, but depends.
Very good. Okay, Anna?
Well, so moving to this question, as we know, we are in an era of tons of information and research. Yet, I would say published information in emerging markets, it's limited and probably, would you say, very often unreliable. So many argue that having boots on the ground is absolutely crucial for managers investing in this market. So how important is maintaining local presence for you guys? And could you walk us through a little bit of your approach on gathering on-the-ground intelligence? I'm going to start with Craig because we know he has one basket with a lot of eggs. So maybe that's going to be the easiest person to start and go across. Go ahead, Craig.
Since I've already spoken a bit, I'll try to keep it short. And as a so we have a private equity and private credit that absolutely, and I'm sure Carl is going to echo this, that when you're talking about dealing with businesses and corporate governance, the ability within our space to be on the ground and be able to see, meet, monitor is absolutely imperative. However, we're talking about the hedge fund, and in our hedge fund, as a macro and relative value manager, while we do have offices and we do ingest information, it's not. I think the issue is what is the germane information that moves our markets, and you're not going to get the information that we need by being on the ground necessarily in the market. You're going to get the information by being in communication with the counterparties. So, for example, I was just in Nigeria and Cote d'Ivoire in August. And my entire trips are meeting counterparties and solidifying those relationships with banks to be able to gather more intelligence from them, from what they're seeing, their interactions with the central bank, with other asset managers, with offshore, onshore, right? What their opinions are. That becomes much more germane. And one of the things too, from a macro perspective, is I think I've been doing frontier markets for 16 years, and I think sometimes the narrative takes over rather than the analysis. So if you're on the ground in Lagos right now, one thing that is striking is the lack of traffic, right? So in the past, Lagos is infamous for being a megalopolis with just mind-bending traffic jams, right? And I was there, and we were whizzing around the city, which is unheard of, right? Given past experience. So how do you interpret that? right? Is it the fact that, I mean, we know that there's a shortage of petrol because you see the queues for all of the petrol stations. Is it because people don't have the money? Are they carpooling? Are, you know, what is the driving factor? And how does that play into what we are actually trying to accomplish? So sometimes I think you for at least what we do, we have to be very focused on policy governance, what the macro issues are and what the market is telling you, as opposed to on the ground. Now, I'm sure people who do equity, that's going to be completely different. And for our strategies that are focused on credit and equity at the SME or corporate level, that is imperative. But for what we do, it's really more important to have the framework and the macro analysis and the connection with the markets and the policymakers.
Perfect, thank you. Carl, can I go to you and you can briefly tell us what is your approach?
I do mainly equities, but as I told you, I invest in liquid, large caps usually. So I am based in Dubai, and definitely that's an advantage to be on the ground, to have access to information, but also to feel what's going on. I mean, I can tell you that in the 8 years I've been here, I've seen an incredible change. And being on the ground, you can feel it differently than hearing it over the phone. So it's quite important, I think, I mean, for me, it was additive to be based here, but it's also important to travel to the countries you invest in. And totally with Craig that as I said before, I mean, when you have a network of local knowledge, be it at the level of policymakers or management that you've been talking to for years, and that you trust, that is very important rather than having, I mean, not all of us, anyways, not me, I don't have the capability nor the money to have offices in every country I invest in and employ there. So that would be, it wouldn't work. So I think it's important to have some people you trust and then to travel to these countries.
Fantastic. Ghana, what is your approach to that?
I think what really differentiates an EM investment approach to make it a successful one is the need to have close on the ground research and active travel, both developing local context that can provide you color and also insight into local situations. Because I think absent that, you're just one more person downloading data from from Bloomberg and from the web. And I think it's hard to necessarily believe that you can source, identify, and frankly be the first to source and identify idiosyncratic alpha opportunities. And I think in what we do, everyone does something a little bit different, but I think one thing that's consistent is identifying a situation first is gold. And I think unless one is on the ground and knocking on doors, so to speak, I think it's very difficult to do that. So if I think about the broad kind of EM universe, it doesn't make a lot of sense to compare data sets across EM countries without controlling for the very important control variable called a political economy specific to a given economic situation and the various constraints and opportunities that different EM economies face. Maybe just some examples. If I think about Argentina today, which is clearly undergoing a radical economic reform agenda, and which has firmly planted the fiscal anchor into the ground as the basis on which that reform agenda, as the pivot point, if you will, for that reform agenda. And if you look at the economic challenges Argentina faces, I mean, there are clearly countries in the world that would have, considered restructuring their liabilities by now, given those reforms. But that's not what this story is about. This story and this political economy and this trajectory is about something else, and it's about trying to improve the situation rather than sort of overturn the apple cart, if you will, or overturn the chess table. And so I think understanding that local flavor and local color, I think, is super important. Maybe if I just give one more example. I remember when the war started in Ukraine, everyone, and by the way, including myself, was convinced that all Ukrainian corporates would all pretty much bury their head in the sand, default, and disappear. And certainly, you don't have to ask my opinion on that. Bonds were trading at 15, 20 cents. So I think kind of that spoke for itself, if you will. And yet, when I fast forward a few years, of course, people who follow the market well will know that actually no Ukrainian corporates have defaulted, actually. or none of the issuers. In fact, there have been 0 defaults in Ukraine since the private sector issuers since the start of the war. And I think you can only get that perspective if you were to talk to locals and talk to companies, understand their motivations, frankly, their financial situations, and the adjustments that they're willing to make. And I think people would understand that their willingness to pay was as rock solid as it was before the war. I think at that point that left investors with the question mark of handicapping their ability to pay. But at some point that does remove one element of risk premium, and that's of course a source of opportunity. So I think all of this just kind of shows that without close issuer dialogue, whether it's a sovereign or a corporate, I think without that, I sort of feel like EM investing is a bit flying in the wind, if you will. And what is I think Manuela mentions the kind of a huge dispersion in EM, which should be a source of opportunity for a manager. If you're not close to the ground and actively engaging, then that becomes, frankly, a challenge for you as an investor and a risk. But if you're close to the ground engaging, that becomes kind of your opportunity to source alpha and gain alpha.
Thank you. And Hack, you guys, I don't believe, have issues with the resources at Wellington. So what is your approach to that?
Yeah, no, Greg made a very important point earlier, which is if you haven't been covering emerging markets for a long time, you see narratives take over at different points and they just feed on themselves. So I think from our perspective, we think just to differentiate ourselves, the key is to follow these countries for a long period of time and know them inside out. And that's the only way you can differentiate yourself from the person next door and not be just sucked into the narrative on the ground. So we have 4 in-house economists that cover all global emerging markets, and they look at them not only from a shorter-term perspective, but also from more of a medium-term perspective as well, looking at what kind of fiscal frameworks they have, what kind of monetary policy frameworks they have, what kind of fiscal deficit and primary deficit they're going to be running to keep their debt sustainable over a medium-term perspective. And I would say, to add a step further, you don't just need those connections from just the local perspective. You also need it to have those connections with the multilateral agencies like the IMF, like the World Bank, like the African Development Bank, because a lot of these will in terms of stress, come and see the same things which you've been following for a long period of time, which is how are they going to make the debt sustainable, or is the debt sustainable at all? And do we need a restructuring of the debt or not? So I think knowing that, it just gives you a strong advantage to know whether this country is going to make it or not, or is it going to get into stress? And the only way to do that is follow them for a long period of time. Just as an anecdote, I was just from what Jenna was saying, I cover all global emerging market sovereigns, and some of them have proper fiscal frameworks in place, and some others just publish their next set of data, quarterly data on Facebook. So the amount of information you have to go through for these different sets of countries, only by having boots on the ground, only by visiting those countries, having your context there on a regular basis, you can parse that much information. Otherwise, you'll just get into the short-term narrative of this is what's going to happen, and no one knows what comes after that. So I think that makes a big difference for us.
Thank you. I want to follow up a question, which is also about the risk, about governance, because I mean, I don't think that anybody argues that our governance, corporate governance, plays a crucial role in an investment. Doesn't matter developed countries or emerging market, but in evaluating investments in emerging market could be challenging because of the lack of transparency, constantly changing regulations. So can you share with us how do you assess and incorporate corporate governance in your investments? And I'm going to switch a little bit and start with Manuela, because she's an allocator. She is not a manager, but like from your perspective, what is important for you in terms of the corporate governance in emerging markets?
Well, first of all, what we assess is also the governance of the fund in which we're going to invest. So that's, I think, it's key, because it's also a reflection of how important the manager is looking at this thing, also on the companies he's or governments he's considering for investment. So for us, that's and I mentioned before, I would say we put a lot of importance on the operational due diligence in the case of emerging market funds, even more so for frontier market funds. And when we talk with the manager, we always try to understand what kind of process they have in place in order to dig a bit more. So I think Diana was mentioning before, it's not just looking at the numbers, but going, to actually to understand a bit more what is in between. And on this regard, the network, I think it's key. So gathering information through counterparties, also assessing the quality of the counterparties. That's also for us extremely important. So when we look at the manager in the emerging market space, we also always try to understand who's dealing with, what kind of counterparties he's working with. And Craig was mentioning before, getting to understand the quality of these counterparties. And this gives a lot of information which is not readily available, on the usual database or through the usual channels. So that's absolutely important, and it's absolutely important also the experience. So also, I would say the track record of the manager in the sense of even mistakes made in the past, that can be definitely very important for the team to reassess, their process and make sure that some mistakes are not repeated.
Thank you. Kenna, would you like to add anything to that?
Sure. I would just say that a long time ago, someone told me how you do some things is how you are assessed or believed to be doing everything. And so I think if companies, and I guess funds too, as Manuel would say, who do poorly on governance and due diligence are probably sloppy on other things as well. And when we look at a corporate governance framework, and we think of governance both as political governance and corporate governance, for us, it's a key determinant of risk premium. By the way, I should just point out that it's a timely question, given that this week 3 Nobel Prizes were awarded to 3 economists for their work on the importance of building quality governance institutions as laying the bedrock, if you will, for long-term sustainable economic growth. And so when we think about governance, we try to consider one of the important things we think about is what are the potential upside downside risks, or I should say gains or potential losses from improvements or deterioration in governance. So if I'll start maybe as a sovereign, I would just say I've always thought, for example, Venezuela is a terrible place to invest because I think the country has been institutionally gutted over the last 2 decades by Chavismo, which I guess you could argue everything has a price, but at some point one can still, I think when you run the numbers, you'll see that price is very low, and maybe the price on the screen doesn't even assess that. But then you hear similar people raise similar concerns about Turkey for the last decade. I think those concerns are ill-founded in Turkey. I think they're misplaced, but you hear those concerns as well. I think you can also pay attention to some of the big successes, and the one that would come to my mind is obviously Peru, where a very strong institutional framework, and they've had some wild political scandals, and they've elected some pretty interesting characters to lead the country, and yet the institutional bedrock remains quite strong and remains in place, and Peru is rewarded for it. Peruvian spreads are as tight as ever, and that says something. I would just say lastly, I think it's an interesting point how much attention this question is getting. And I'm not sure if it's just from ESG, but Sri Lanka, which is in the process of completing a debt restructuring, is considering, and I think some of the details are probably not to be shared in a public forum, but is considering a governance-linked bond, which would effectively set certain targets for the country in terms of governance. And if the country is able to meet those targets, that would reduce its debt service costs. And if there's governance rollback, then that would increase the debt service costs. And that's kind of if you think about it, it's a bit of a win-win for everyone. Sri Lanka benefits by having better governance, and of course, investors benefit from having much tighter risk premium or credit spreads, which will more than offset any reduction in debt service costs. So I think these are all very important questions, and I think anyone who doesn't talk about governance when thinking about EM would be remiss and missing out on a key important component of risk premium.
Fantastic. Thank you, Eric. We have so many more questions to go to.
Yeah, folks, just let us know if you can stay a little bit longer past our a lot of time since we're approaching 10 minutes. Can everyone stay a little bit longer, or just let us know if you need to leave? But thank you. The last 2 years of, of my survey, I've highlighted the wars in Ukraine and the horror show that's going on in the Middle East. And this particular question is for Gena and for Carl, because you have direct connections to Ukraine and to Lebanon right now. And I just wanted to know personally, if you wanted to share any thoughts about what you can, what you're feeling and what you're seeing going on in these respective countries, and then back to finance, how they're playing a role in shaping your assessment of risk and opportunity. Gena?
Sure. Thanks so much for that. Well, as you suggest, Ukraine is a personal matter. I was born in Ukraine, of course, and have spent much time there. But I just want to say that we have our first obligation when we think about portfolio management has to start with the obligations that we signed up to our investors, and those don't mention our personal kind of political feelings. They mention fiduciary to do well by them. And so I think the big challenge for any investor is to try to segregate, if you will, your kind of personal emotions or feelings to, frankly, just what's the best expression of risk return for your investors in any one situation. And from my point of view, when the war started in Ukraine, I was convinced that, as I suggested earlier in the early stages, that the onslaught would be overwhelming, and of course it turned out not to be. And eventually the front line stabilized. Eventually Ukraine was able to adapt to a wartime economy. It's certainly not the first to do so. I'm based in the UK, and the UK did that for 5 years. And of course, Ukraine was then able to source a tremendous financial economic support from its partners. And at some point, as even people are already pricing what a post-war Ukraine looks like, with reconstruction money coming in, and potentially a whole new set of relationships and alliances, both security alliances and economic alliances. So I just want to say, I think it's very important that that kind of, for me, I tried to do my best to use my personal connection to the country more as a source of opportunity, if you will, to think that I have perhaps an edge or a better understanding of the situation than perhaps maybe somebody else who without that personal connection.
Thank you. And Carl?
I mean, listen, I'm being Lebanese and having my family there. I'm definitely worried with the turn of the events, but that's on the personal level. And as Gena said, when it comes to the investment in the fund, there is no place for personal feelings. And I approach the situation exactly like any other major event that has happened in my universe over the last 16 years. And believe me, I've had my fair share because I am not Ukrainian, but Russia used to be part of my universe. So I've come through that, and the Arab Spring, the Georgia War. I'm sure I'm missing some. And my approach has always been one of risk, reward, and probability of events. And right now, for example, the Middle East offer a fantastic structural story driven by reform. But I believe that the risk reward is not very attractive because of what is, in my opinion, again, about to happen. So as I told you, I am in active management, given that the risk is out there. Even though I do like these markets, I will pare down risk and wait to have better clarity.
Thank you. Linus?
So back to sort of current events, China launched what can be described as a massive stimulus package. The equity market rallied. They're obviously trying to sort of awaken the animal spirits of the Chinese investors. There's been articles sort of describing how busy the brokers are opening accounts for retail-oriented onshore investors. Is this something that's going to stick around, or is it just sort of a temporary rally in the market and eventually going to fade out, or is this really change for it? I think Mihak is probably our China specialist in this case, but others should feel free to chime in. So,
Sorry. Well, I'm not the China specialist, but yeah, I'll take a stab at it. I think with what China has done, definitely, I think in the shorter term, it removes the tail for sure, which is people were pricing in really downside scenarios for China after the property downturn and how it's created a vicious circle with consumption running really bad and growth coming off sharply. And I think with this monetary and hopefully fiscal stimulus to come, that tail has been removed for sure. But but to answer your question, whether it will stick around, I think a lot really depends on the seismic event we're going to have, which is the US election, because a lot will depend on what comes after that. And if we are going to enter into a world of tariffs and trade protectionism, I think, and trade wars, frankly, then that changes the calculus a lot. That could be another hit to consumer sentiment in China. That could be another hit to consumption. That could also mean a lot of things for the Chinese RMB, which I think will create a very different environment. So all else equal, I think they've done enough to start generating that animal spirits. I think a lot more needs to be done. Putting a floor on, especially the property sector, would really help in that, because that's been a major drain over the last years, and that will help spur private consumption and private investment. But it remains to be seen also what happens with the rest of the world and how protectionism plays its part in that, in my view.
I mean, if I may, you said China awakened the market participant animal spirit. The problem is really awakening the real economy animal spirit. And the problem of China is not one of availability of credit, it's the demand side that is problematic. So, and you have youth unemployment at 20%. So I have to agree with Mahak that they put a line, they took out the tail risk, but for this to continue, it's going to probably take a bit more time and data points that show that, I mean, consumer confidence is starting to pick up and people are starting to re-engage. So it's the billion-dollar question you asked.
Anyone else would like to chime in, or is this going to sort of add more oomph to the emerging market space at all? So.
Okay. Anna?
Well, so I would like to very briefly address the climate issues, even though I have to say, living in the US, I always worry that when I say climate, people right away think politics. It has nothing to do with politics. We cannot ignore the increasing in frequency and severity of climate-related events, especially in emerging market areas, economies. My question for you is, have you integrated, and do you integrate climate risk assessment in your process? And if you do, could you give us a little bit overview, or give us a little bit, overview of your approach? And let me start with Gena.
Sure. Well, I just start by saying I think obviously climate risks matter, and I think if you're living in Florida, it's hard to dispute that. But let's focus on our universe in emerging markets. I mean, Ecuador is currently experiencing a nationwide blackouts because of droughts, which, by the way, which I should just point out is also a function of earlier decision-making to overly depend the country on hydro, which left them quite vulnerable to this question. And we've seen the effects of droughts in other markets. I remember certainly in Turkey, renewables generation was quite poor in hydro as well. We saw in Pakistan, frankly, the opposite effect, where you had mass flooding, which set local parts of the Pakistan economy back for years as a result of flash floods. And this just takes me to one somewhat interesting recent example, which is this tiny little island of Grenada, which, for those of you who have been fortunate enough to visit, is in the Caribbean islands, and was basically a victim of a hurricane, which led to tremendous devastation. And in their attempts to recover from that devastation, they took on a lot of debt that they weren't able to service, which triggered a default. And actually, in their new bond, in the restructured bonds, there's a hurricane out. And what I mean by that is, to the extent there's another hurricane and it causes too much damage, they can suspend debt service and not necessarily be deemed to be in default. So this goes back, and I think it's just interesting how the last two questions you brought to my attention. One is relates to governance, and here relates to climate, and how more and more capital markets are adapting, if you will, and addressing to these various which some refer to as ESG challenges in the capital markets. And so I think any investor would have to pay attention to the importance of climate change, and in some cases, and I think it's, historically it's always been sort of a bit of a tail risk, and I think at least anecdotally, the number of situations, or statistically, the number of situations that come up suggest that it's a little bit more than a tail risk, but a proper kind of left tail risk event that has more than kind of some trivial probability associated with it, but it's something that matters and that you have to assess in your overall risk management framework.
And Mehak, would you like to address this?
Yeah, sure. So I think environment is a big factor in the investment, and we need to take that into account, especially given that the number of such things that have been happening in the emerging markets over the last few years. It's like floods in Pakistan, droughts in Ecuador, in Southern Africa. It has real fiscal costs for the countries and does have a massive drain on their resources. So it has to be taken into account when we are doing our investing, and we're doing a lot more of this environmental analysis and seeing which countries are most susceptible to it. But also, I think there's a flip side to it as well. Right now, whether that's public markets or whether that's multilateral agencies like the World Bank, there is a lot of funding available for these projects now through green bonds and blue bonds, green bonds for environmental stuff and blue bonds for marine and ocean life projects. And I think that can help, one, increase environmental awareness amongst a lot of emerging market countries, because I feel that's also a big hurdle in terms of dealing with that. And then secondly, getting them access to the funding. So once they can identify the projects, there is a lot of cheaper funding available rather than just going through the normal route of funding from the public debt markets to put investment in these projects and safeguard themselves against these things happening again and again, or at least have some countermeasures against them to help the population. So I think there is more and more awareness that's happening both globally and within the countries. And all we need to do is identify more and more projects which can help increase the awareness locally and also help them in dealing with these things.
And Manuela, just briefly, I know you are an ESG specialist, so can you also touch on this issue from your perspective?
Sure, absolutely. Well, for us, the level of integration of ESG in the investment process of the managers is key. We realize that ESG is becoming, I would say, difficult word in some parts of the markets, but we think it's actually the basis of risk management. So this integration could be more or less explicit, but we think that a good manager should have it for sure in its risk management process. And this is not just for emerging markets, it's very much so for developed markets, because, I mean, we saw what happened in the last few weeks, but most importantly, sometimes things that happen in emerging markets on the environmental side can affect the rest of the world. And one example was the drought that affected the Panama Canal last year, at the end of last year. That affected the entire world. And in a situation where the Suez Canal was already disrupted by geopolitical situation in Middle East, you can imagine, how much it impacted not just emerging markets, but really, all economies. So we think this has to be absolutely an important point in the agenda. And I believe it's not just a matter of short-term analysis, but sometimes also long-term evaluation. We know that China, for example, based all the green energy revolution on the fact that pollution had touched really very high levels. So it's also considering what can happen in the future and how the countries and the companies, of course, can react to this kind of risks, which I fully agreed with Gena. Natural disasters today are just intensifying, not just in magnitude, but also in frequency. So it's not a tail risk, it's actually an important risk to consider.
Thank you so much. Lena?
So before we start wrapping up, I'm going to ask you sort of what are the main opportunities, the sort of the market you should be looking extra closely at, and what are the sort of the main risks here? So I would suggest ladies first. Manuela, would you like to kick off where you see sort of most of the sort of where you would like to allocate your money into EM? Which is there a manager type or is there a specific market you're looking extra closely at?
Well, we actually always put China aside. I would say Asia related to China in a specific bucket. So that's something we constantly monitor, and we try to assess the best candidate to, cover that part of emerging markets. And then the rest of the world, we are actually always looking with a lot of interest in Latin America. Latin America has always been part of our portfolios, both on the credit and the equity side. So that's definitely part of the space that we think gives also always a lot of opportunities. We have been out of Africa for some time on the equity side, but we are reassessing some frontier markets because we think that some of them are, getting back on, let's say, investment level for us on the equity side, while we have always been a bit active on the credit part. And another point that we are very interested in is energy transition and how this is actually included in the portfolios of our emerging market managers.
I think I have to give Craig a little bit of counter here because you were not that positive on Africa. So maybe Craig has a different view on it.
The opportunity in Africa is, this right now is back towards local currency. So over the last 2 years, we've had 65-75% devaluations in Nigeria and Egypt, which are, again, when you look at Africa, the four largest issuers, which account for 75% of the local currency market, are Morocco, South Africa, Nigeria, and Egypt. So, given the magnitude of their size and what's going on, the aggressive change in policy on their side, the interest rates that are on offer. Unfortunately, the cycle that has been occurring in Africa for the last 15, 20 years has been this step down function in the currency. I mean, the appreciation, but the devaluation against the dollar, is that every time they do this, they burn another set of investors, right? So you end up with people who never want to hear Nigeria or Egypt again, who had their money stuck, who could not get money out, who have had the Naira. I've sat with U.S. pensions that sat there for 4 years and could not get their Naira out. And so what happens is every time they do this, they end up resetting the bar, and effectively to pay for their past policy sins, it has to become worse the next time. So back in 2017, when Nigeria they did a series of devaluations from 16 to 17, and they ended up at about, probably on the interest rate side in the low 20s. I think we were probably around 21, 22%. We peaked. Right now we have 32% T-bills on offer again. So and that is in the face of a 70+% devaluation, I would say a reorientation and a truly change in the monetary policy. So to us, local currency now has a strong appeal in terms of, especially if you're structuring it correctly, and hopefully that's what we do, and the returns show that. Hard currency debt does still have some appeal, especially with the Fed cutting. EM, real money has one view, tactical allocation and more alternative have a carry view of it. So obviously with the cost of financing decreasing, that's another strong element that is often overlooked in EM debt, is the fact that, as the Fed is cutting, that is just adding to the bottom line. So you should see some strong support for EM debt. So no, we're very, very positive on Africa right now, and especially within our portfolio. we think the scenario looks something like what we were able to do from the 2017 to 2021 period, which was quite strong.
Thank you. Mehak, any particular sort of areas, countries you would look extra closely at, except China, of course?
No, look, I think from a macro perspective, as Greg's been pointing out, like we've basically seen inflation come down, which was very high over the last few years, and because of that, global interest rates are coming down. And at the same time, global growth is actually doing okay. It's not, we haven't had to go through a recession to kill inflation. And I think that plus the China stimulus that's coming through, that creates overall a very positive environment for EM and EM flows, contrary to what we've had over the last 2 years, where EM currencies were depreciating and money was moving away from EM. We should see money coming into emerging markets. However, in the short term, I think both in hard currency and to some extent even in local currency, we have priced in much of that soft landing already from an overall perspective. And we have now the US election to contend with, and there will be winners and losers out of that. So right now, the focus is to make sure that we identify those winners and losers and have that differentiation. And I think that's what investors give us money for, to know where to put it in times like these, rather than just being long the asset class, because I think that trade's to some extent already played out, both in distressed space and as well as in African space as well. So I think it'll be much more about differentiation into year end. But overall, the environment for EM is very positive if Federal Reserve stays on the path of cutting rates and inflation does indeed come back down and stay low, and global growth is holding okay.
Or would you like to chime in?
Yeah, I mean, in my smaller world, first of all, I mean, I agree with Craig and Mehak, but it looks like inflation is coming off. I'm not sure that it's dead yet. On my side, I was a bit surprised by this 50 bips cut that looked now, after what the numbers that we've seen, looks a little bit of politically motivated. But let's see what comes out. If the Fed is able to continue cutting rates, definitely it's very positive for EM in general. Now, in my world, and I don't want to talk a short term, it's more of a, I think that the transformation that is happening in the Middle East is turning these markets. I mean, when I say these markets, is Saudi and the UAE into structural stories from cyclical. In Saudi, you have a population, 60% of the population is below 30 years old. So these reforms are not going to stop. The market is now, I think, 4.5% of MSCI EM. So it's no longer a tracking error. And if MSCI upgrades South Korea, it's becoming bigger also. And 50% of global allocators have zero to that country. So I'm not saying now, it's you have geopolitics, and then the market is not very cheap. So we took a step back, but the sectors to look at are those aligned with these reforms, which are healthcare, infrastructure, tourism, and the other country I would look at actually is South Africa after the elections. That is potentially a game changer, but not enough time.
Jana, would you like to?
Sure, thanks. I mean, I think the overall, I think as I look at the lay of the land, we had after completing this almost decade period of, or actually slightly more than a decade period of QE, which led to tremendous asset proliferation. We saw in 2022 this tremendous reversal, if you will, of this very sharp rate spike, which of course is very painful for everyone, and obviously is particularly painful for EM. I should just point out that in 22 we had the largest redemption period in EM fixed income in history, which speaks a little bit obviously to the quantum of asset creation, but also speaks to the reversal of sentiment and approach to EM. And so unsurprisingly, from this kind of huge creation of assets to then a big repricing and an evacuation of ownership from those assets, unquestionably, there has been tremendous opportunity over the last couple of years in kind of participating in the cleanup, if you will. And that cleanup comes in different shapes, has come in different shapes and forms. Some of it has come through default and restructuring, Sri Lanka and Ghana, and I guess Ukraine would be three case studies there. But then there's also just been very powerful reform, moral hazard support to avoid that. And Egypt and Pakistan would probably be two names that come to mind. I guess in Ecuador. And I just would just say that I don't think that story's over yet, actually. I think at the sovereign level, it's probably mostly over. At the corporate level, I would say that it's not over, actually. And in fact, if anything, I think unlike sovereigns who are always in the market, so to speak, so are always price takers, corporates are only price takers if something is due. And as a result, some corporates were able to, notwithstanding where their bonds traded, the real business itself didn't necessarily, as a result of higher rates, didn't necessarily have to suffer as badly as you would see in 22 and 23. And of course now, as rates remain elevated, some of that pain is now being is filtering through, if you will, the system. So I think we're seeing more and more opportunities in being part of a corporate cleanup story, and that's true in Latin America and Africa, and frankly in Eastern Europe and the Middle East. I would say that remains an attractive opportunity in emerging markets. And like so many things, I think the opportunity set is going to be driven by the primary capital pricing country on earth, which is the United States, right? Which sets the kind of global cost of capital for the most part. And I hope my American accent doesn't suggest that that's in any form an example of overly American hubris. But I think it's still certainly for emerging markets, U.S. rates are a key determinant for success. And I think if you look at the last cycle, and 2 cycles ago, from the U.S. recession of 2022 to 2028 to 2008 to Lehman, you had this period of sharp rate cuts in the face of the U.S. recession, while EMs continued along their secular growth, and it led to just a massive boom in EM asset prices from 2002 to 2008 across equities and fixed income. And I would say you could see there's the outlines of such an opportunity, perhaps recreating itself in the coming periods.
Thank you.
If I may add, I think it's important not to put EM in one bucket. I mean, if you look at, I think Bank of America published today, I think the flows, and EM got the biggest inflow for a long time. Why? Because China rallied 30%, and every allocator that was underweight was afraid to lose their job, so they went and bought China. And that's, I mean, with all the managers here really navigating in other markets. I'm thinking of Craig in Africa. It's not the mainstream, and we live in a world where now, I'd rather not take the risk of Africa or Turkey or Zimbabwe or I don't know what. Because I don't want to lose my job, so I'll just stick in with the index, and so it's very, very important. I mean, for whoever is listening to us, that you have specific structural stories in all of these EM, and not to put it all in one bucket.
I also don't want to take the risk of Zimbabwe because I don't want to lose my job either.
I don't know anything about Zimbabwe. So it came out.
Guys, you were so generous to stay with us a little longer, but can I ask you just to answer one question that we got very specific to one of your comments? And the question is the following. Argentina was mentioned as a potential interesting story for investing in, but not quite yet. If I heard you correctly, what are the other countries could be inspired if Argentina is a success story? Could Argentina be the beginning of a bigger trend for how EM countries can be managed? Anyone who want to take that?
Sorry, did I understand the question correctly, that I said that Argentina is a good place to invest, but not quite yet?
That's correct.
No, I definitely didn't say that. Or maybe I misspoke or it was misunderstood. No. I understand the reference. I understand the reference to St. Augustine. I understand the reference to St. Augustine, but I would just say, I think Look, everyone has their own. There's no right or wrong way to invest, and I think actually what this panel shows is that there are different perspectives, and the only right way to invest is what works, and the only wrong way to invest is the one that doesn't. I mean, it should be trite. But I think in Argentina, what we're seeing is a very, very important, frankly, shift in the center of gravity of politics, and obviously every investor has to handicap how much of that is permanent and how much of that is not, and how much of that will survive Milei. Milei is not president for life, right? He's president for 1 or 2 terms. Take your pick. And so how much of that is a semi-permanent shift in Argentina's political axis, and how much of it is not? I would point out, of course, that Juan Perón, we're still living with his legacy, many decades later. So an impactful presidency matters. But I don't think it's right to say that Argentina is the only country undergoing such change. And I would have to look at Ecuador as a potential, kind of baby version. I hope it doesn't sound right, but as a smaller example of what we've seen in Argentina with a center right shift in the center of gravity, and frankly, from those who study Ecuadorian politics, I think would agree that that center of gravity has legs, and that rightward shift has legs for the upcoming election. Where Charisma seems completely on its deathbed. And so I would just say that I think that there are definitely more examples of countries that are making this kind of proper, I would say, removing some of the straitjackets, if you will, to economic growth brought on by statism that has survived from the 70s somehow miraculously to the 2020s, and who are trying to remove some of those shackles. And I don't think Argentina is the only country to do that. And I think, frankly, an Argentinian success story would probably create more copycats.
All right, guys, thank you so much. Thank you so much for being generous with your time. And I want to thank everybody for joining us, of course, especially our panelists. And we hope you found this discussion interesting. And again, if you have any questions, feel free to reach out to Eric, and you can always send questions to him through LinkedIn, or you can in touch with us, any of us. And again, thank you so much, and have a wonderful day.
Thank you very much.
Thank you so much.
Thank
Take
you.
care.
Thank you, everyone. Thank you very much. Bye-bye.